Hi everyone, welcome back. Nice to see you guys. We are here at the weekly live FXStreet.com review of the week with me. So let's start by taking a look at the calendar, right? Uh, First, I would like to say that uh, the summer is almost over in Europe, but still we are seeing thin volumes across the market. I believe that it's the thin volumes we are seeing these days is mostly because we are waiting for the ECB this week and the Fed and the Bank of Japan next week. You know, the market has been rolling around central banks for over than 2 years already. And the fact is that the latest Fed statement has been a game changer, right? Not actually, sorry, the Fed statement, but Shailen's statement in the opening remarks at Jackson Hole, because somehow she reaffirmed that the central bank is in the tightening path, right? And on the other hand, we are expecting the Bank of Japan and the ECB to provide some new easing. In fact, I do believe that the governor of the governor of the Bank of Japan, Kuroda, sorry, said earlier this week that although he acknowledged the risk of cutting rates further into negative territory, he will apply any existing or new tools to achieve the 2% inflation target, right? We also have the ECB buying bonds. I know there has been some slowdown in bonds buying this month because mostly of due to summer doldrums, which means that we will probably have some front buying during the upcoming months, and the ECB buying more than the average 80 uh, billion euros, right? Uh, that it has been buying lately, or establishing the minutes in their statement because of upcoming December doldrums. Anyway, the fact is that both central banks, the ECB and Bank of Japan, are in the easing path. So that means that they are going in the opposite direction of the Federal Reserve, and at the end, that will keep on favoring the greenback over there, particularly those two currencies, right? On the other hand, we have the United Kingdom. We have a strong bounce in macroeconomic data in August, right? We have lousy readings in July post Brexit, and a sharp recovery in 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 that figures, probably due to a cheaper pound, right? More manufacturing, more sales. Uh, so the fact is that this bounce in macroeconomic readings make it tougher for Bank of England to cut rates further, right? So that particular central bank will likely remain on hold. That said, the pound seems to be much more stronger against the greenback that the euro and the Japanese yen could be. Okay. Anyway, let's take a look at macro calendar, what we can expect for today and the rest of the week. Of course, today the attention will be in the service sector in the United States because we have the official on the market. Um, oh, seems that the market has been moved. Okay, oh, sorry. I was for yes, the market has been moved. It was scheduled for today, earlier today, but it's okay. Seems we are going to have just the ESM report today, which will provide us some clues about the health of the service sector. Overall, lately, the service sector has been the strongest, not only in the US, but in the rest of the world. So we're expecting an uptake in the figure and final revision. And I believe that if that's the case, the dollar may advance against the euro and the yen particularly, but with a negative reading in here, a downward review below that 555.5, we are going to see the dollar getting in trouble. And in that case, I would prefer to trade it against the pound, right? Because as I said, when the dollar seems to be weaker and the pound is stronger, you always have to look on the balance between the strength of the different currencies, right? And the euro is weak, the yen is weak, the dollar is also weak, right? But pound is strong. So that's the way to play. Anyway, Um, I do believe that, of course, the focus of attention will jump into Thursday and the ECB, but on Wednesday we will have some data coming from UK manufacturing and industrial production. These figures are from July, so we're probably not going to be that outstanding as we have been seeing with the PMIs. But if anyway we see an improvement in here, and I believe that June readings were upbeating also, then I'm seeing the pound nearing 135 this week. Guys. We'll go to technicals later, but the 135 region is like a milestone right now for the pound. Anyway, tomorrow we will also have Bank of Canada rate decision. The bank is expected to remain on hold, but it usually we are lately having a hawkish central bank. So that will probably keep on fueling Canadians dollar rally, particularly if oil prices keep on recovering, right? Anyway, we have discussed this largely and we will discuss it again. Oil between 40 and 50, it's in a comfort zone. I would say closer to 45.50 than to 40.50 is a comfort zone. And despite we may have some outside or side of that range, I do believe that that is a comfort zone that will prevail until year end. Okay. Anyway, as I was saying, the ECB on Thursday will gather all of the attention. No rate cuts are expected. No changes in their amount of bonds by a monthly basis. So again, all of the attention will be on Draghi and his assessment of the economy and any hint he could give us over what's next for the ECB, if they are considering or not further easing, and even if we have some confetti, right? I remember. Anyway, the press conference will be the center of attention. I'm pretty sure we are going to hear some dovish comments from Draghi, but I'm not sure if that will be enough to move the euro farther out of its range or its recent comfort zone. Okay, and for Friday, I do believe that Chinese inflation will be in the center stage. Chinese data has been improving modestly over the past few months, and I believe that's one of the reasons the Australian dollar isn't is not plummeting these days. So if some good news came in here, high yielders will probably benefit. Okay, um, in the Canadian and Australian dollar being probably the most benefit among majors, right? European data, German trade balance, it's hardly a market mover. Trade balance in UK could be interesting this time also because of Brexit. Market is paying too much attention to post-Brexit and data. Okay, and I could say that if we will have a good number in the year that's will further support my case for the pound reaching 135 before the weekend. Um, we have unemployment in Canada, the payrolls in Canada also. Not expected to affect the rest of market, but as usual, it will affect the dollar CAD and CAD crosses in the usual way with better than expected numbers fueling the currency and worse than expected readings waiting on it, right? We have added the cut positioning for mayors and gold and oil lately to the calendar. I know this is not a big market mover, but I love to have this in here. Will probably help us uh, uh, give us right a record notice of how the market is doing, and it's that that will help you trade long trade or see where the interest is. Its market interest is hard. I don't know. I hope it gets useful with time when we have enough historical records. Okay. Anyway, moving out of calendar, let's go to charts, which are far more interesting for me and hope for you too. Give me a second. I can share them. Okay. The euro dollar pair is getting really, really boring lately. Uh, we don't have much definitions in here. Um, the post-payroll spike up to that 12-15 region, having been quickly reverted, is telling me that the upward potential is well limited for the common currency. As I said, the report, the net non-farm payroll report, was not the best we can hear from the U.S. At this point, right? It was quite disappointing from in all of its subcomponents. But the fact is that it's not enough to put the Fed back on hold, because if you consider the upward revision that we had to July numbers up to 75, and this 151 we had in August, it hardly changed the annual average of payrolls, which stands around 180, 85 new jobs added, 185,000 new jobs added per month in the US this year, which is pretty impressive, right? So the revision plus the 151,000 announced on Friday were in line with average 4.9. The unemployment rate is uh, is within Fed's comfort zone. In fact, it matched previous. So again, it's not a big issue. I do believe that the biggest problem of the non-farm payroll report was the slight shallow tick up in wage, right? Which are still low, and that is holding back consumption, and that is holding back inflation. And the Fed actually needs inflation to base its decision to raise rates with a firmer conviction, sort of speaking. Anyway, back to technical. Sorry, I lost my north. Back to technicals, as I was saying, the fact that the pair was unable to move beyond 112, it's quite a negative signal for me for the pair. We have been consolidating around 1120. If you heard me a couple of times, you know that I do think that this is a major static support level. If you take a look at your daily chart, you will find that the price stalled around that level multiple times over the past year. It has been a daily high, a daily low, intraday. Also, it's a big level, so we should suspect some stops below that 1120 price zone, and therefore consider the fact that if the price breaks below it, we would probably extend this decline and down to 1040 price zone. Okay, also big static support. Below this level, 110 and 960 region are the next probable supports for this week's and bearish targets, while towards the upside, the 12 and 1250 region are also strong static supports, and we will need to clear this last Friday's high to talk about a bit of more of recovery here up to that August high around 1366. But overall, I do believe that the common currency remains weak and that the risk is towards downside in here. And I would rather consider selling at higher levels than buyer at lowers. Okay. When it comes to the pound, the price has been struggling with this 33.20 level for most of this week, right? If you take a look at this chart, you will see that it's the 23.6% retracement of a post-Brexit decline, and that even ever since the Brexit, right, the pair has been in trouble to recover that level. In fact, we had some spikes beyond a daily basis, but they were quickly reverted. So I don't know. I don't see much. It's a tough, really tough level, and we're struggling around it, not yet confirming that we'll break higher. In fact, we had a high yesterday at 33.75. We had August high around 33.71, right? So the upward potential, as I was saying earlier, seems strong, but we are still need to clear this area. We'll still need to run above it. I would say that about 34 to see the pair reaching the 35 region, right, which is in here where we have the next round of post-Brexit highs. 34.80, 35.20. That's the probable bullish target for the pair. If you see the chart, you will notice a huge gap right after the Brexit. I believe everyone has that gap in their charts. It's not just me. So for the most, what I'm thinking in here is that if we somehow break above that 35, the pair will run to fill the gap and rise up to 36.40, right? That stands for the 38.2% retracement of the same decline. And from what I can see, this is the most the pound can rise these days, right? Particularly if the Fed maintains its hawkish stance. Beware of that. Anyway, and towards downside, the pair has been meeting some buying interest and has immediate strong support around 32.80. Right, take a look at what we have here, and also this week low. So below that level, I can see the pair falling down to 32.50 and towards the 32 region. But to be honest, I would expect some buying interest at lower levels, particularly if UK data continues to be positive, right? When it comes to the Aussie, I was following this trend line because the pair broke it earlier uh, that last week and attempt a couple of pullbacks to it and were rejected. But well, the decision of the Reserve Bank of Australia last night to keep its rates unchanged. In fact, that Governor Stevens, outgoing Governor Stevens, this has been his last statement. In a couple of weeks, we will have a new governor there. The fact that he says that the economy keeps growing, uh, and that he is still concerned a bit by low inflation, but there has been no strange change in the world in towards the downside when it comes to inflation, but an upward tone when it comes to growth has helped the pair to recover, the Aussie to recover above the trend line, which means if by the end of the day the price recovers and closes above it, I will probably erase it, right? Anyway, what you can see from the technicals is I'm still keeping on up my, there we are, my this year rally Fibonacci retracement, because the pair has been having quite battles around those levels ever since early June, right? Respecting them and was breaking above it or below it, rallying, and has been a quite nice technical study to follow, you know. And the fact is that the 23.6% retracement stands at 76, and well, we broke above it, we're standing above it, and it should now be major support. If that level holds in dollar strength, then the Aussie will probably recover its shine and run up to this highs we had in August around 77.50, right? And I'm still believing that there's a good chance that on a break above it, we will retest the year high of 78.13. Somehow, on the other hand, the pair lose that 76 level. We have an intermediate support around 75.30.40, right? And below that, then we have a major one at 74.15, which is the 38.2% retracement of the same rally, yearly rally. Okay. And for the dollar Japanese yen, I'm quite surprised of this latest recovery, to be honest. Uh, I was really not seeing much of this upward potential coming. But what I can see in the daily chart is that the price is still trading below its 100 simple moving average. Remember, we discussed this last week, and we said that only if the price was able to stabilize above 105, there's a good chance of further recoveries. I have checked the calendars, and we have the Fed meeting and the Bank of Japan meeting both in less than 12 hours. One, the first one in an American afternoon, and the next one during the upcoming Asian session. So on September 21st, I do believe. So I don't expect much from this particular pair until then, right? We'll probably see some consolidation, some moves that will probably retrace or reverse, who knows? But for the most, what I'm seeing in here is some consolidation for until September 21. Sorry, guys, not much coming out. Anyway, what I can see in the shorter term is that the price has moved above its moving average, but honestly, moving average remain uh, quite flat, little directional strength coming from there. Although the 100 is moving slowly towards the 200, but given that the price is making lower highs, I don't see much of a potential for a rally in a year. So for the most, I would say that that 104.40 level 14 should cap the upside, right? And that the pair will probably find some buying interest on approaches to 190, 103. Okay, if we take down the level, the pair can fall down to 100 to 40, okay, and even lower towards this region, so around 100, 160. But honestly, not expecting much more of that. Above this one, on the other hand, 105 seems the next probable target. And although I don't expect the pair to reach this level this week, if somehow it settles above 105, then 106.60 is my next bullish target. Okay. Uh, Gold prices are cheering, uh, modestly at least, the positive non-farm payroll report. Right, the negative, sorry, non-farm payroll report that's making gold positive. But overall, the upward potential seems needed still because the pair is struggling with this region, the 1330, 1350, 35 region, the area. We have plenty low highs, a moving average in the daily chart, a Fibonacci retracement. So for me, it's a tough bone to break, and I don't see it breaking above it today or in these upcoming days. The pair needs more data to break above it. If we have really negative readings coming from the US, then maybe the rally can extend up to 45.20. Okay, that region is probably the next probable bullish target. And above that, we can go up to 57, 58, but honestly, not seeing much towards the upside right now. Okay, still on the other hand, 13 seems to be the base. We have been trading as low at 1302, so below 1300, then the risk turns towards the downside. Not much definitions in here for me. And finally, when it comes to oil, hopes of again we are still with the same hopes of an output freeze has helped it recover earlier this week. News that Russia and Saudi Arabia are working on a program to forming they want to form a working group to help oil producers uh, to take decisions to stabilize market, meaning they did not make any announcement, they did not take a certain decision. So the early hopes of an agreement being made to freeze output have been diluting. As I was saying, 40, 50 seems to be a comfort zone, but at this point and in the short term, for me, the risk is towards downside. Okay. Um, if we lost this region 44.20, 44.30, then we would probably retrace the lows around 43, which are also the 61.8% retracement of the latest bullish run. I see a line in the sun market when it comes to market sentiment around 42.15. As a break below it would probably feel the decline down back down to 40. But that's the most. Anyway, guys, I believe that's it for today. Sorry, I really have to go. Thanks for sharing this time with me, and see you back soon. Okay, probably on Thursday, I do believe, with the ECB, and hopefully Ohio Mauricio will be with us to help us go through the news. Thank you, and bye bye.